Welcome, everyone. I'm Rich Hans, Global Co-Chair of our financial services sector here at DLA Piper. Today, we will discuss the ripples created by the business regulatory and litigation activities in the aftermath of the collapses of several banks, including SVB, earlier this year, and to see how it's continuing to impact the industry in an uncertain economic environment and what we can expect to see in the coming year. Today's discussion is the latest in our series of fascinating discussions with thought and industry leaders this year about all of this. What we've learned over the course of these discussions perhaps should not surprise. That is, that banks do not fail in isolation, that one failure often leads to another, that the regulatory response to the failures often addresses the last war but does not anticipate the next one. The regulators and those charged with oversight of financial institutions are not infallible, that they too make mistakes and often fail to appreciate the fault lines before the crash. I encourage you to stick around for the next 40 minutes. We have a fantastic panel here, and let me introduce them now. Nicholas Varone is a senior fellow with the Peterson Institute for International Economics and host of the Peterson Institute's Financial Statements virtual event series. His research is mostly about financial systems and financial reform around the world, including global financial regulatory initiatives and current developments in the EU. Isabel Ward is the U.S. co-chair of the firm's financial services sector and co-chair of the Global Class Actions Group. She has been instrumental in resolving some of the most complex and high-stakes disputes for financial and banking institutions worldwide, equipping her with a profound understanding of the emerging litigation risks that these companies will likely encounter in the coming months. Margot Tank is the U.S. co-chair of the firm's financial services sector here at DLA Piper. It's widely considered a pioneer throughout the global fintech industry and has played a pivotal role in driving digital transformation and ensuring compliance for financial services companies for over 25 years. Today, she will share her perspectives on the emerging global regulatory implications that financial services companies are facing as the ripple effect from the banking failures continues. And finally, Whitney Cloud is an active partner and thought leader within the firm's financial services sector. And during the discussion, she'll offer her thoughts, predictions, and horizon scanning around the emerging white collar and other risks for the banks and their personnel. Thank you, everyone. Let's get into it. So, Nicholas, I'm going to start with you. You studied and spoken about the U.S. regulatory model, in particular, how the U.S. regulatory regime stands up to the European regime. What are your takeaways from what happened this spring and your perspective about what in the regulatory regime worked and what did not?
Obviously, you have to look at it very holistically, and there's a legislative framework under which everybody operates. There is a set of regulations that in the US are provided by the different agencies, and there is supervision. The fact that the agencies, and there are many of them in the US as in the European Union, have to make sure that the regulations are complied with, and that beyond the strict perspective of compliance with regulatory obligations, such as capital requirements, banks are safe and sound. I think the biggest contrast, and this is something that I don't think many of us maybe would have expected, I certainly wouldn't, between the US and the Eurozone. I'll focus my EU remarks on the Eurozone, even so it's not the entire EU, as you know. But it's like 90% of the EU banking sector, so it's not a bad approximation. So the big contrast between the US and the Eurozone has not been so much in terms of the content of regulations that banks had or didn't have to comply with. It's really been on the quality of supervision. And the fact that, to general astonishment, the US authorities have been unable to fulfill in a satisfactory way their supervisory mandate on banks like Silicon Valley Bank and Signature Bank. And this involves, of course, several regulators, the Federal Reserve, the FDIC, the state authorities of New York, of California, and others. This, I think, is one of the big surprises. But where's the other surprise, if I that way, is that you didn't have equivalent failures on the Eurozone side. The single supervisory mechanism, which is centered on the European Central Bank, has been put together a decade ago after widespread supervisory failures in the individual Eurozone countries. And I don't think there was a perception until this year that the resulting supervisory system in the EU could perform not only well, but even better than in the US. And that's what we've seen in the recent phase of interest rate rising and business model challenges. It appears, at least so far, that the European Central Bank and the single supervisory mechanism around it have been better able to deal with interest rate risk and business model risk than the US federal and state regulators, which to me is the biggest discovery of this whole phase.
It's fascinating. And Margot, how do you believe the regulators will respond to the bank's increasing use and reliance on technology to deliver banking services, including the use and acceptance of digital assets in 2024? I mean, so much of what the regulators are doing is trying to fix what came before, and they often love to regulate that which they don't know. What do you see here?
Well, it's an interesting question. The use of electronic signatures and records to engage in the business of digital banking on a nationwide basis has been enabled since the enactment of the Federal e-Sign Act in 2000 and early revisions to Article 9 of the Uniform Commercial Code. What we're seeing is the continued migration by banks away from paper. COVID clearly accelerated the adoption rate. And as a result, more banks, in order to serve customers and remain competitive, are using third-party vendors to help them offer digital services. This past June, the federal banking regulators issued joint guidance reminding banks that they are required to operate in a safe and sound manner and in compliance with applicable laws and regulations, and the use of a third party to help banks offer products and services, including offering them electronically, does not change that requirement. There will be continued pressure on banks to do increased due diligence on third-party technology providers before engaging them for services, and a requirement for ongoing monitoring of such providers, exit strategies or backup plans for services so as to not leave customers at risk. So an increased emphasis, not just due diligence at the outset, but through the entire relationship, taking responsibility for offering electronic and digital services. In addition, as a result of this shift to paperless transactions, including for consumer and commercial loans, either secured by real property or by equipment, and to ensure sufficient liquidity and financial stability in the event of real or perceived systemic risk, where we have been post bank failures, the Federal Reserve banks and the Federal Home Loan banks have been responding by offering banks an opportunity to facilitate pledging large volumes of loans evidenced by instruments that are in electronic form. So while these loans are able to be originated and sold into the secondary market, and there's great legal precedent and support framework for doing this, there's been a lot of resistance using electronically signed loans or image loans as collateral in the event that a bank needs to submit them to the federal government for liquidity purposes, for long-term debt purposes. So the addition of electronically signed loans is providing flexibility to banks to increase their pool of pledged collateral, again, in order to meet the liquidity demands. And as we'll see, liquidity demands as one of the regulatory fiats in the coming year. Banks will need to review their electronic processes to be able to certify to the governmental requirements associated with pledging the collateral. And finally, with respect to the issuance and custody of digital assets, the non-traditional assets such as stablecoins and other types of virtual currency, the banking regulators had pulled back the reins a bit on the ability of banks to offer these services for the time being. There was legal precedent over the years. The business of banking clearly included all things digital, but the bank regulators post the Biden administration executive order to really think through the regulatory landscape and the risk to customers, consumers, and systemic risks. The bank regulators are letting Congress consider the best approach for enabling banks and non-banks to be able to offer these payment related digital products and services. So a lot going on, a lot yet to come in 2024.
That is a lot, for sure. Isabel, you've been having, I think, a series of discussions with our colleagues in the UK in particular. And what ripples are they seeing, or have they been seeing in the international financial markets from the shocks of the spring? Is there still that ripple being felt over there?
Our recent conversations have been revealing, just like in the United States, the bank failures showed not just the US, but globally, that interest rate risk is real and that this is something that had potential to spread very quickly. Our international colleagues were on heightened alert when everything began to develop in the spring. There was immediate concern about contagion, with attention moving very quickly to Europe and particularly to the Swiss banking community. A disaster was averted there, like it was in the United States, but our international colleagues have in particular flagged that there may be an expectation that regulatory intervention will happen again. And that's not something that we can rely upon or that anybody else can rely upon. That may not be the case if there's a future problem. And they're also talking to us about some of the slowdowns in activity that they've seen coming out of these ripples. In particular, our colleagues in the UK are reporting that M&As seem to be slowing down and that there are worries about refinancing risk, and that many of the existing credit facilities are not set up in terms of cash coverage and ratios to deal with ongoing interest rate risk. We're also seeing that perhaps many lenders globally are not prepared to do appropriate hedging, and that has been an issue that continues to perk along out there. There are definitely some borrowers that have already been caught out, and perhaps some lenders as well, and that area definitely bears further watching. Our colleagues in Latin America have also reported that some of the larger banks have withdrawn from that market, potentially due to the cost of business in that area, and that regional banks have stepped in, but some of those were affected by the ripples from the failure, and they may not have the systemic strength of some of the larger banks in the event of a future crisis. So also something else to watch there, and apparently also continuing liquidity pressure, mostly from economies in Latin America that rely upon the dollar. And lastly, our colleagues have also flagged that there is real concern about the exposure to real estate in China. There's been a good deal of movement of resources out of China, in part due to geopolitical issues. So things moving off into spaces like Vietnam and Indonesia. But there's also been a reliance on sovereign backing for the Chinese banks, and that is not something that should be taken for granted. And also some concerns, I think, about where corporate restructurings are beginning to appear in that environment, and even about whether there may be some disclosures and potential ripple effects into the Chinese economy and even to individual Chinese consumers.
There's a lot there. Obviously, the ripples continue. Whitney, we're some 7 months removed from the failures it seems most mid-sized banks have survived without the deposit risk and despite the credit environment. It's not to say they're safe and they haven't struggled. Many have, but where do you see the litigation risk right now? Where does that? What are some of the latent risks that banks should be on the lookout for here, even 7 months out?
Yeah, thanks, Rich. I think what we see after a financial crisis, even a smaller one like happened in the spring, is it's not the headline institutions that are going to face the longest litigation horizons. Rather, it's peer institutions that were subject to some of the same pressures and naturally doing after action internal reviews, analyzing what went on, that may become enforcement targets down the line, particularly if those internal communications and analyses of the risk are not then properly disclosed to shareholders and regulators. As a former prosecutor, you always remember that the cover-up is worse than the crime. In this case, it's not just federal enforcement authorities that financial institutions should be mindful of. Those have proliferated. Certainly, it's not just Department of Justice, but plenty other institutions are taking a more robust enforcement role. But we also now have state attorney generals who are definitely more active in this space than they were in prior crises. And we know that state attorney generals are taking a muscular view of their consumer protection and antitrust powers. We've seen that in the life sciences and tech space. I think we could easily see that in the financial services space if they find a visible and attractive enough target. But regardless of the enforcement authority, one thing's for sure, shareholder suits are an unfortunate constant. It's not all doom and gloom in litigation. The good news is from the financial crises this spring, the ripple effects were shorter and shallower than I think a lot of people anticipated. But those same underlying risks that you touched on are still present. There are fewer deals happening. Now we can expect some increased regulation, as Margot was touching on. And from those kind of competing pressures, as financial institutions want to improve business offerings or improve profitability, there are a couple trends that might be worth keeping in mind on in terms of litigation. Synthetic risk transfers that we're starting to see more of. What's in those loan portfolios and how they are disclosed will be incredibly important to counterparties and to regulators. And then, as Margot was touching on, incorporating more of tech and AI, financial institutions have to be mindful of that those new business partners are far less regulated than financial institutions. So it's definitely something to keep an eye on as those new offerings are incorporated into the business.
There are certainly real risks there, for sure. Isabel, let's go back to you. What are some of the other risks that you think the banks may be facing from shareholders and other private litigants in 2024 and beyond?
There will definitely be litigation coming out of the events of earlier this year that have not yet materialized. There are a couple of places that we think merit particular attention. The first is commercial real estate. That remains on a slow burn, and there may be over-concentrations of CRE at some institutions, and perhaps not a full understanding of the risk that lurks in some of those portfolios. The easiest example of that, of course, is office buildings, where workers are not coming back in the way that they were before the pandemic. And particularly some of the older buildings with lesser amenities may ultimately reach a point where they just can't continue, even with accommodations by the lenders. And in fact, we see some of this already starting to play out in Northern California. So I think we'll see some restructuring in that area, potentially some lender liability challenges and other litigation, including regulatory attention, where these assets were perhaps not properly flagged and mitigated initially as this trend continues to mature. We're also seeing that there were some weak companies out there that were essentially finished off by the pandemic, but they've struggled along with government funds and lender accommodations, but are now reaching their limits. And these are what we call zombie corporations. They're essentially dead on arrival. And those, again, need to be accurately accounted for by the lenders as troubled assets, should not be supported when it becomes clear that there is little or no legitimate potential recovery. And this is already creating a trend where some of those companies are unfairly turning on their lenders. And this is frankly particularly offensive, where the lenders have worked with those borrowers through the pandemic, including modifications and forbearances and other support, only to find no gratitude at the end of the day. And again, we're tracking that interest rate risk. We're now learning that a lot of institutions are sitting on unrealized losses, including losses from the bonds where the interest rates have been kept higher. Recent estimates put those losses as high as $650 billion across the industry. So this is something we need to keep an eye on. The earlier failures may have changed the playing field. We have now seen the first run on a bank by social media. It developed at lightning speed and it was not containable. So we're now thinking there may be a heightened obligation to be on top of these types of issues. And of course, we can't forget about the potential for FIREA claims, which often materialize years after an event. Additionally, there's new sensitivity to where the attention of the banks have been focused. The crisis opened the door to criticism over certain ESG practices that some claim have distracted from safety and soundness. And I do think there's some litigation risk there, particularly involving credits that were heavily focused on things like climate change and perhaps were prioritized without realistic underwriting or recognition of the risk, and potentially some concentration issues around those as well. And then lastly, the crisis has raised some interesting questions about how bank customers may adjust their own practices to avoid liability. We saw in the crisis that there was a lot of concentration of funds in singular institutions and that the FDIC insurance coverage was not there when those funds suddenly could not be accessed. That was averted at the last moment, but I think there will now be conversations about whether all operating accounts should be kept at a single institution, and perhaps some negotiation with banks about reasonable accommodations on that issue. There may also be litigation about the failure to disclose the types of risks of concentration and keeping funds at an institution that are not FDIC insured. And then lastly, there may be a heightened duty to investigate a bank's safety and soundness before you choose it as a banking partner. And that could potentially result in liability for companies where losses or lack of access to funds manifest later. And certainly if there are further disruptions that come out of these ripples, we will see this come to the forefront very quickly.
There's a lot there, for sure, Isabel, and I agree with much of your assessment there. Nicholas, let's circle back to you. You study the banking regulatory regimes, and you've examined whether mega banks were a problem for financial stability. Those mega banks had more of a moment this past spring, as we know, in Europe, and you've looked at those issues recently. You've looked in, especially in the context of the EU Bank Resolution Framework. I'll note as well, I mean, there's stories this week in the Wall Street Journal about UBS swinging to a loss as it still continues to absorb Credit Suisse. What are the risks you see now, whether in terms of an overcorrection in the coming years, or increased regulatory pressure on these banks?
Well, one thing we know about systemic risk is that generally it pops up where it's not expected. And this year was a splendid illustration of that general wisdom. I don't think that a year ago, many people would have predicted where the crisis indeed was located, geographically, functionally, you name it. So let me act as a fool and try to make some forward-looking statements. At this point, it doesn't look, there is no obvious concentration of risk in the system, because the increase in rates, which has created a lot of friction, seems to have run its course, at least at this point. Of course, central bankers are clear that they don't want to be complacent. They will remain vigilant in the face of possible new surges in inflation. But at this point, they have paused the pace of interest rate increase that they have held in 2022 and early 23. So that means that the stress that could come from those interest rate increases will be gradually absorbed by the system. And therefore, the kind of dislocations that we saw this spring is not going to happen again the same way if that is confirmed about the monetary policy direction in the next 6 to 12 months. Now, of course, it might be that a number of problems have been kept under the carpet in the last few months, and they will be revealed in the next few quarters. That's very possible, but at least the initial source of that stress, the rapid increase of interest rates, seems to have been posed. Now, of course, we live in a difficult world. We've seen the hack of a Chinese bank a couple of days ago, creating turmoil in the markets. Cyber risk is a major concern for everybody. I'm not even going to mention geopolitical risk and the litany of risks that we're seeing around us these days. So there's absolutely zero reason for authorities in charge of financial stability to be complacent. And in some jurisdictions, there are major challenges that are very well identified, starting, of course, far away from here, but very important for the global financial system with the real estate market in China. But I think it's important to note that the recent cause of systemic fragility, the ones that triggered the problems at Silicon Valley Bank and at Signature Bank, albeit importantly, maybe not at Credit Suisse, you mentioned the Swiss case, was the interest rate increase, and that has come to a pause. Let me come back to the Swiss story, because I don't think the fact that UBS is booking a loss for a quarter is in itself a cause for systemic concern. And the general view among analysts at this point, and you see that in the share price, is that UBS indeed made a pretty good deal by purchasing Credit Suisse the way it did earlier this year. I think it is actually quite remarkable that we have seen the unwinding of a very large bank, one of the 30 or so globally systemically important banks in the world, in a way that was actually quite orderly. So there has been a lot of controversy and debate and indeed litigation and lots of work for lawyers from the Credit Suisse case. But I think the fact that it has been absorbed by the system the way it was, I think carries important lessons, some of which are actually quite positive.
It is actually amazing that we haven't had larger ripples, larger waves coming down the pike since then. Margot, I'm going to swing back to you. The U.S. regulators, where are they going next? One of the challenges I think a lot of folks have been fearful of is that they would go a little too far, that they would be regulating that which was not the problem at Silicon Valley Bank or Signature Bank and the like. And so there's still this big chasm, and actually comes back to you as well on perhaps on the digital assets. But where are we now in terms of regulatory reform, and what is that going to mean going forward in 2024?
Yeah, setting aside the digital aspects, just focused on pure business of traditional banking. There was a recent report in April that has been well read by most in the industry, where the vice chair for supervision of the Federal Reserve acknowledged the need to bolster resiliency broadly in the financial system and identified a number of regulatory reforms that the Federal Reserve intends to consider following the bank failures, most prominently a reevaluation of the tailoring framework that relaxed supervisory standards for some banks. The Fed specifically is likely to focus on rules relating to liquidity risk, increased capital, stress testing. As a result of some of the earlier bank rules in 2019, many firms were accepted from some stress testing requirements or granted more lenient timelines to conduct them. The Fed is likely to revisit the scope of stress testing to reach more banks with 100 billion or more in assets. Any adjustments to the rules are going to have to go through a notice and comment rulemaking process and likely would not be effective in the near term. However, there are other areas that the Fed, as part of its supervisory authority, is likely to focus on that will not require regulatory changes. I mean, they'll be able to, by regular order, increase focus in certain areas. What we're expecting is heightened regulatory scrutiny on the fundamentals of banks' business models, risk management programs, including appropriate design, day-to-day management, and issue escalation. This could mean more challenges to management and boards to address risks and supervisory findings more quickly, or more of the supervisory criticisms being escalated to non-public and or public enforcement actions, such as consent orders, litigation. I think some of the issues that Isabel was raising more quickly than in the recent past, greater scrutiny as the bank grows and approaches the next supervisory asset size tier, or perhaps even at the authorization stage with more pushback for high-risk business models. Requests for and scrutiny of wind down plans. I think that's going to be a very big focus. Fostering a strong commitment to a culture of compliance, especially in the absence of any legislative or regulatory changes, is really going to be a must. Banks are going to have to work together internally to put in good processes and procedures on an ongoing, consistent basis and revisit them more than just occasionally as we go forward.
The culture of compliance was a point of some discussion with Mike
Yeah.
Silva when I
Exactly.
cast with him earlier
Yeah.
this year. I think it is an important thing. How do you measure it? That's the challenge, certainly for us going forward. Well, folks, it's been a fascinating discussion. We could talk endlessly, I think, about all of the issues here today. To our audience, thank you so much for taking the time to be with us today. We hope this provided some clarity about what's to come and what has been going on. For those of you who have submitted questions during the session, we will do our best to answer them in the coming days. And we'll also share a copy of the recording link for you to forward to your colleagues and industry peers. And of course, we will continue to watch closely all things around banking as they progress. And to be sure to visit our dlapiper.com/Ripple for short videos, podcasts, and more on this subject. Thank you all again for being with us today, and I hope you have enjoyed our discussion. Thank you.